Okay, folks, welcome to the Gamma Optimizer live video. As usual, the first question is how is sound, how is video? No, hopefully this is not if sound is bad, I guess you will not hear the question, but it looks okay. But if you can type on the chat window, it will be fantastic. I'm just waiting for some feedback. Okay, so let's start. Thank you, Victor. I have decided to open the live video to everyone because it's an interesting juncture in the market. It's a short week. We have vacation tomorrow. So let's see what we have in store for today. So as usual, I start with the closed positions. Close positions, we have nothing. We haven't done a single official trade. Doesn't mean that we are not trading. It's just that we don't have any official trades. I don't understand why the VRP 3-session trade hasn't been giving us positive signals for a while. I guess I think the options are too cheap and the risk reward is not there. But the end result is we don't have any positions yet, so we don't have anything to show for here. Okay, so let's move directly into the market regime. And by the way, you can ask questions at any time. There is a typical delay of 10 seconds between the questions you type and I can see them, so be a little patient. Try to get them at any point, I'll try to come back to them. Okay, so in terms of the GT level, when I prepared these slides, the GT level was at 3,949 and the market is above that value, therefore we remain in a long gamma regime. And this has been the norm for a while. We have been long gamma for a couple of weeks. I was expecting this week to be long gamma, as I mentioned in the room, and even in Twitter I was expecting to be long gamma. The market is behaving really well. Remember that in a long gamma regime, we expect to see very low realized volatility in the near term. So in the next 1 to 5 sessions, we expect to see very low volatility in the market, and that also coupled with upside drift. So we expect the market just to drift. It's just the natural thing of the market, just drifting slowly. Another reason for a very slow drift is the imbalances. You can tell the imbalance on the way up for a 1% move up is about 32 billion of selling of notional. That's a massive amount of selling. That means that if the market for some reason moves on its own 1% up, options dealers will be forced to sell 32 billion of notional only for the S&P. And all that selling pressure is going to oppose the upside move. So that imbalance up is going to keep the market really quiet to the upside, really, really quiet. On the way down, it's not as massive, but it's significant, 18.6 billion of buying. That's not bad. I mean, that should also keep the market a little stable. If it tries to sell off, then dealers will be forced to buy, and they will help a little bit when they sell off. So the whole picture that I want to convey here is that all of these hedging imbalances, up and down, will keep the market trading around this value. I expect the market to trade around 4,000 for quite a while. And around could be 20 points up, 20 points down. No, that's kind of a round for me. Or 1% up, 1% down. No, let's say now we are at 4,000 and 40 points up, 40 points down. And the reason is because of hedging activity. We will need to get really strong organic buying or strong organic selling to overcome the hedging. Hedging is becoming very, very meaningful in the market. But this is good, and this is the kind of hedging I like. Hedging against the market, we like this because dealers are not inducing volatility, they are actually taking volatility out of the market. Okay, so let's look at realized variance. For the last 20 sessions, the past month, it has been around 14.39%, which is actually decent, very low. I like it a lot. For the last week, it has been a little high, 15%, but it's more or less the same. No, there is not that much different. Sorry about that. So I like that we are seeing kind of low realized variance both monthly and weekly, which is consistent with the current long gamma regime. Of interest is that VIX is also kind of low, around 18.02 when I provide these slides, and it should be more or less the same. And notice that there is not much distance between what VIX is at and the monthly variance. It's only around 4 points of volatility. So VIX is not overly overpriced versus realized variance. And the other thing is that we have a long weekend ahead, and the long weekend affects the computation of VIX. For those of you that know how VIX is computed, you know that VIX uses calendar days as opposed to trading days. So there is one less trading day than usual, and it tends to lower it a little bit, in particular on the last session of the week, which is today. So I will not trust such a low reading of VIX right now. Let's wait until Monday and see where. I expect it to go a little higher on Monday, not because the market is going to fall, just because the period that is used to compute VIX is now going to be correct as opposed to one short one day. So in terms of realized variance, again summarizing here, I don't see anything out of the ordinary. I like it. I actually like what I'm seeing. Is expected of the market. The market is slowing down massively, and it's not due to lack of interest. No, people think that, oh, no one wants to buy it. No, yeah, there is plenty of interest. It's just that there is lots of hedging on the way up. So all that interest is met with lots of selling from option dealers that have to remain neutral. That's pretty much it. I mean, when you have 32 billion of selling, that's a substantial amount. I am surprised that we broke 4,000, to be honest. I was not expecting it to be broken like solidly today. I was expecting the market to oscillate around that value a little longer. Okay, so let's look at the term structure. Remember that the term structure represents the VIX values for different expirations. Now it's basically the VIX computation at different expirations, and instead of putting a date, I am putting the distance in terms of days, so 0 to 200 days, calendar days. And the blue line represents current values, and the red line represents the variance from last week. And you can see, compared to last week, last Thursday, we are lower. The whole curve is lower, which is actually good. No? That means that finally implied volatility is starting to come down. Finally, the prices of S&P 500 options are starting to reflect low volatility in the market. I also like, if you look at the front part of the curve, I also like the heavy contango in that part. It's very steep, very heavy. I like it. It means that dealers don't expect to see anything out of the ordinary in the next 20 calendar days. That's pretty much it. No, it's like smooth sailing. So this is a great picture, and I'm going to couple this with another piece of intelligence, is that seasonality favors very low volatility in April. April is one of those months where seasonality favors nothingness. so that's good. No, that's good. We are having, like, the current shape of the term structure looks very calm. We expect seasonal effects to be really calm, to have very low volatility, and we are seeing a tremendous imbalances on the way up, and that should also help. So from different sources, we are having confirmation that we might have very low realized volatility in the near term. I know people get nervous because, whenever volatility comes down is when you expect crashes to happen. No, but I don't think this is the case right now. At least not yet. This is the case of finally the volatility world is starting to normalize. When was the last time we saw VIX below 20? I don't know. It's a tough question, because this is like more than a year ago. No, so it's actually nice to see the front of the curve to be substantially below 20. Like the first 50-something days are below 20, and that's very good. That's very, very good. So any questions about the term structure? Okay, so let's move to realized variance. In realized variance, the same picture of beautiful, healthy things. For those of you not familiar with the chart, the blue line represents intraday realized variance, which is different to the normal realized variance. This is what is happening intraday during the session. So it captures any craziness that we might have. It captures any crazy action. And you notice that we during March, early March, if you look at that, the blue line at the bottom, you will see a couple of peaks, like really crazy action happening. And then the red line represents VIX, and then you can see that VIX didn't even bother reacting to that craziness. And sure enough, now realized variance is back to normal, back below 10, and VIX is finally coming below 20. So this I like. I have a question here about, can you discuss current levels of ambiguity? Yes, I will discuss current levels. I was not prepared, but I will mention them. I can mention them a little bit. When we look at the variance center, I can show ambiguity. So overall, I think this is actually really good. Overall, I think that in terms of realized variance, everything is consistent. So all of the worlds are consistent right now, and that's what I look for. I look for little inconsistencies between the different worlds that we have, the worlds of realized variance, the worlds of implied volatility, the worlds of intraday variance. But in this case, all of these things seem to be very consistent, showing market to be in a nice civilized regime, which I expect to continue into April. Okay. That being said, I expect the 4,000 level to be the level. It is big, nice round number in S&P 500, and big, nice round numbers have a tendency to attract price. So I will not be surprised to oscillate around that level. Remember, a few points, like 40 points up, 40 points down, 1% up and down from that level, I think is a good bet for the next couple of weeks. Until we can see all that imbalances disappearing a little bit and providing more freedom for the market. Okay, so overall, this looks very good. Let's see if I can get ambiguity from some place. Yeah, I can get ambiguity. Yes, so let's show quickly ambiguity here. So I can answer the question. So let's flip a little bit to extend, so you will see my RStudio here. Because I didn't prepare any slide, it's going to be a little fuzzy, but you can see ambiguity. Ambiguity is the O2 column right here. So ambiguity has been around 0.09, 0.1, 0.09, 0.87, and now it's 0.11. And that's kind of on the lowish area now. In fact, I can plot it now. Let's plot ambiguity so you can see it in a chart. Let's plot ambiguity. I don't have ambiguity here. Let's see if I have ambiguity here. Okay, so now finally we have a chart. I hope you are seeing the chart on the right. You can see ambiguity is very low. We have a peak and we got a little mini correction in the market. Now ambiguity is kind of on the low side, far from the 0.2 area, and I like that. So in terms of ambiguity, I don't think that that's much we can add. It's not a factor at this time. I guess that's what I want to say. So I hope that answered your question. Coming back to the presentation, let's move on. What is the trade plan? Okay, the trade plan is, if we get a positive signal for the BRP trade, I'll take it. I am still a little skeptical of ULG trades, but next week I guess I'll give you the green light, because today is the first day of April, so not much can be concluded from today. But next week we can see on Monday how we open, and because we expect to see low volatility during April, then I will expect to see very cheap option prices, and the ULG trades should start lighting up again. Well, they have been lighting up in terms of signals, but I don't know in terms of performance. I have not been tracking the performance. So that's the plan. BRP extraction trades for as soon as we get them for 3 sessions, and ULG trades starting next week. So remember that a couple weeks ago I asked you guys not to do ULG trades, and so now I'm giving you the green light for next week. I haven't finished yet, so let's now look at the variance center before taking more questions, open questions in the room. So let's go to the variance center and see what the variance center has. Okay, so intraday action, pretty boring. We are around 4,000, which is expected. The GT level moves a little bit, but not that much. It's still 3,951. The imbalance is also very gigantic upside imbalance. This is a very huge imbalance. And even the downside imbalance is very big. I mean, we are at a point in the market that the market should not move. The market should just remain glued around a price. And you can also see here in the realized variance for today is extremely low. The total cumulative realized variance is 5.12, which is really extremely low. And the realized variance for the last 30 minutes, for the last half an hour, is 2.6. Man, this is incredibly low, incredibly consistent with everything we are seeing. Also incredibly consistent with people just taking off on vacation, that no one is around. It's basically, this is going to be watching paint dry for the rest of the session. In terms of the gamma imbalance per strike, you notice that we have the 4,000 wall is gigantic, and this is the wall we are seeing. It has a 4 billion only on that strike of selling on the way up and 6 billion of buying on the way down. This hedging wall should keep the market in this area for a while. Okay, and the next big hedging wall is at 4,050, which my God, I will be surprised if we see those things, but you never know. No, suddenly when the market wants to move, it moves a lot. So in terms of imbalances, everything looks pretty good as well. The kurtosis for the day has been 3.15. For those of you familiar with kurtosis, that's almost Gaussian. That shows that whatever is happening in the market today is pretty random, pretty randomly distributed, Gaussian. There is no exchange action, unlike last Friday when we saw the liquidation of that hedge fund, and that was interesting. Okay, so everything looks good in terms of realized variance and gamma imbalances. Let's look at ultra. The ultra predictions look very good. You guys know that I will look at this. Those are the predictions for the ultra, and you notice that the means have been positive pretty much for the past session. So ultra has been positive, although more than positive, kind of neutral, no? 0.11 and mean is almost 0 now, it's almost 11. The good thing about the standard deviation is that ultra is predicting lower and lower volatility. And I like that. You know, it started 2.28, 2.27, now it's only 1.86. So I like that ultra is predicting lower volatility into next week. In terms of trades, I mean, you guys have all sorts of trades you can take. Remember that the only official trade that we are doing in the room is the BRP 23, no, the 3-session BRP 20. And it looks like we are going to have a trade today. So remember that these trades are only meant to be executed really near the close, and the strikes will change. So you remember to check back near the close to see what the final strikes will be for this trade. But it looks like it's going to happen, which is good. In terms of ULG trades, they have been steady, solidly go for a while, but I am not doing them. This is too speculative, in particular around this area. I mean, look at this one. The market will have to move above 4,065. I guess it's too soon for this. You know, let's wait a little bit. But you know, at least Ultra is agreeing that things are looking really good. So far everything good. Of course, this could be famous last words, and we could crash next week. But I don't think seasonality favors anything like that. And then I come back to the presentation. And then now I open the floor for questions. Now, if you have any questions, this was a very short update. It's just before vacation, and there are no any crazy things happening. The end of the month was yesterday, so the little shenanigans at the close were part of the usual things that happen at the end of the quarter. But other than that, I should not expect to see anything weird going into next week. Now, of course, you know, we could go back a little bit below 4,000, but my expectations is that it's going to be tremendously range bound for a while. Okay. So any questions? I'm going to wait for like 15 seconds just to take into account the delay between my voice and you guys typing. Okay, I have a question that Leo and you in your gamma optimizer room, is there a section that describes the differences between ULG 20, 40? I think so. I think I think that I have some material about them, about the trades. So I'll make sure to post them in the room. I have also been I have also wanted to create some kind of YouTube video explaining the trades, but I think that I have already a few. But if not, I'm going to create a video. But in general, I can answer the question right away here, so because it's going to be useful for even non-members. Remember that this meeting has been open to the outside world. So let's go here and I explain briefly what the trades are. They are very simple. No, those trades are very simple. So ULG stands for ultra long gamma. So ULG trades are long gamma trades. What does it mean? These trades seek to, they look for underpriced options versus the probability of something happening. So these trades are trying to identify cases where the options are underpriced. And in the case of 40 is ULG 40, for instance, is looking for the trade that it looks for a binary call price at 40%. So these things are looking for the equivalent of a binary call. So in this case, the binary call is just a vertical call spread. That's because there are no binary calls in the American equity markets, at least not in a very liquid form. So you can always replicate it with a vertical call spread. So this is the vertical call spread, and it's 40% because the spread is around $2 out of 5 width. So that gives you around 40% price, no? So that's it. So the probability of this trade working is 42.84, which is a little edge over the 40. And that's why it's a recommended trade. And the trade will make money if, for some reason, the market ends in April 9 above 4,035. And I will say that it's only 20-something points from here. No, it doesn't look that bad. ULG 20 is the same variation, it's just that it's looking for the 20% price binary call. So it's only priced around $1. $1 out of 5 is around 20%. And so the strikes are substantially higher. The market has to move substantially higher for those things to make money. But the good thing is both of these trades, this trade costs $2 and makes 5. Well, 5 raw, the net is 3. No? And this one costs around $1 and makes 4. So it's like a fantastic risk reward if it works, okay? And these probabilities of the trade working come from the ultra neural nets, the convolutional nets. So whenever the probability is higher than the cost of the binary, then you take it, and that's what the signal is go. BRP trades, on the other hand, are different. BRP trades stands for Variance Risk Premium Extraction. These trades are actually short gamma, and they are the opposite of the other trades, because in this case you don't want the market to move more than what is priced. So in this case we are looking for overpriced puts. Notice that those were with calls. We are looking for overpriced puts versus a probability. And we find an overpriced put, we sell them. So it's a binary put replicated with a vertical put spread. And in this case, for instance, the cost is 20%, which is $1. So we are getting $1 for this out of 5 is 20%. We are getting 20%, but the probability of failure is substantially high. Here, the probability is the left probability of failure. So it's 26%, which is higher than the binary's pricing. So there is no edge. The edge is negative. That's why there is a no-go status for it. And this one is exactly the same trade, but instead of being 5 sessions out, it's only 3 sessions out. So that's why it expires on the 7 as opposed to the 9. And this one uses a completely different neural net that is proprietary. But it's the same concept. No? It's looking for a 20% binary, which will get $1 for it, which is 20%. But the probability of failure is lower, is only 17%. So there is a small edge in this trade. And you can take it, and the trade makes money if the market is above 3,975 by the 7, which is, I think, is Wednesday. No, so or Friday. I don't even know when is the 7th. The 7th is Wednesday. So that's a good trade. I mean, I plan to take this trade. Whatever the strikes are, remember, these strikes are not set in stone. This thing updates in real time. So those are the strikes right now to 25. But take the trade only as close to 4 p.m. as possible. No, that's how the parameters of the trades are. So that's kind of in a few words what the ULG and BRP system is. And by the way, the only official trade for the room is the BRP 203. The other ones are there just for the members. Some members like to take them, but I prefer to only take officially and track officially this one, which has a tremendous edge. I hope that answered the question. Any other question? I'll wait a few more seconds. Otherwise, I'll close the live session. Okay, so thank you, folks, for joining. It has been really a pleasure having everyone here. Okay, I have a question. Do you recommend put or call butterfly center around 4,000 strike 2 weeks to expiration? You think we'll be chopping around here for a while due to imbalances? Well, the butterfly is a very beautiful trade. It's very tricky because you really need to be correct about this thing to be around 4,000. I will not mind a butterfly, but if we arrange bound thesis, I think it will be better expressed with something like the VRP trade that I described. The VRP trade gives you more room, has substantially higher success rate, and it will succeed in the same case that the butterfly will succeed, and so you will have more predictable profit risk reward with that one. But yes, I personally will not do a butterfly center around 4,000, but definitely it's a trade that could be done for the near term. Okay, so now we are approaching the half an hour, folks. Thank you very much for joining. I hope that that you got something out of this little video. And again, if you have any other questions, you can always reach me at the main room, or you can write to me. My email is in some place in the Variance Center, so you can write to me, and I'm very happy to answer questions. Thank you very much, everyone. Have a great Easter holiday. Take care.